When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Fogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Fogan. And now here's Jeff Fogan and Jeff Shade.
Welcome to Premier Retirement with Jeff Fogan, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade. I'm just here to ask the questions, but the words of wisdom and solid advice come from Jeff Fogan, founder and president of Premier Retirement Planning and Wealth Management. Hey, Jeff, how's it going for you this weekend?
Oh, it's going pretty good. How about you?
It's going great, thank you. March is upon us here. March Madness. I mean, there's all this hoopla about basketball. I'm not keeping up on this stuff as much as I used to be, but still, it's sort of a cult thing. I know people that take off from work to watch March Madness. Have you ever done that, Jeff?
No, I'm not. I'm not that big a basketball fan for one thing. The only thing that makes me mad this time of year is that the great weather is about to leave us and is going to go back to 100 soon. So that's kind of my March Madness thing in Arizona.
Well, when you talked about weather, it's completely opposite than the rest of the country. I mean, a lot of people in other parts of the country, most of the country, are saying, hallelujah, March is here. It's going to be a lot nicer weather. But yeah, things turn a little bit hot and muggy. Not necessarily muggy, but they're going to turn hot here in Tucson here in the month of March. And again, doesn't make any difference what month of the year. We're always glad to be on the radio with our listeners here in the greater Tucson area because we never have a lack of things to talk about. And as always, with every show, Jeff, later on we'll answer listener questions, but we want to start off today by talking about some of the things that are in the news. I understand now that rate reductions are probably not going to happen as frequently or as much as we originally thought they were, right?
Well, I never did think they were going to. I mean, that was kind of a big propaganda trick to bait the suckers into the market, I think, to bid it up higher and higher so that the banks can continue to buy their own stocks and the market could continue to milk out of it whatever they could. I don't think, I mean, obviously the economy isn't doing as well as the market would indicate or what Biden would say from his pulpit telling us that Bidenomics is the best thing that ever happened, that inflation is under control. And it isn't. I mean, we had a inflation report last week came out that it was a 0.4. This is the one that the PCE report is the one that the Fed apparently every time a new one comes out, they go, oh, this is the one the Fed really looks at, and so they've got this idea that it's only going to go by 0.4%. Well, that's on a month. Now that's the last 4 months in a row we've had an increasing trend to the upside, and if you times 0.4 by 12 months, that is an annualized rate of just shy of 5%. If you compound it's over 5. So if it goes up by 0.4 every month from here on out, we're up over 5% in inflation. I mean, where's this? We're going to get inflation under control. It's going to be around 2%, and then we can start lowering rates. When the Fed came out in November and says we're going to stop raising rates, I was kind of skeptical then. And then we had an uptick in inflation. I'm thinking, wait a minute. Okay, so as soon as they said we're not going to raise rates again, we're just going to kind of keep them paused there at the 5.5 range, on short-term bonds and, see if that can, crush the economy enough to get inflation back down. But, all the while, they've given this bank term financing program a year ago to solve the bank's problems of billions or even trillions of dollars. I don't know what the total number is, but I've heard estimates, from the hundreds of billions to the 2 to 4 trillion range. And I don't know how we actually get that actual knowledge or figure. I've looked for it and everybody has a different opinion. But bottom line is there's a lot of banks that were bailed out last year in March when Silicon Valley Bank went out of business and other banks teetered on the edge of going out of business. So regional banks, took it the hardest because they've got a lot of exposure to commercial real estate, which, although there was COVID did some rule changes on who had to pay mortgages and who didn't and all that kind of stuff, and who could work from home and who couldn't work from home was done by businesses. And pretty soon all this office space is unoccupied. So we've got this big commercial real estate problem that nobody really wants to talk about, but it is definitely an elephant in the room. And starting on March 11th, which is just right coming up here, a couple days away, we're going to see this coming week, what happens, whether the bank funding program, the bank bailout program is going to basically be called. In other words, the program was just supposed to be for a year and the banks were supposed to pay all that money back. Well, you know what the banks have done with that money? They haven't been loaning it. They've been buying their own stock with it. Look at JP Morgan, all the trading profits they've had. A lot of that's their own stock. I mean, keep in mind, JP Morgan, they're not just a bank. I mean, they are a broker dealer, one of the biggest. You've got Merrill Lynch, that's Bank of America. I mean, they're one and the same. You got Citibank own tons of assets. And then Wells Fargo Advisors, they've got a huge, these big four banks are not just banks. They don't just do lending. They don't just do checking accounts. That's just their way of putting a grip on a certain segment of the market population and hopefully getting their investment money. But their big bucks are really generated internally by being what we call market makers. In other words, they make the market. They buy the stock and they basically determine the price of it, what they're going to sell it to the public. And they, may bid against each other. But I think more than anything lately, when you look at stocks that only grew at 1% last year in the S&P 500 and 7 stocks basically contributed to virtually 100% of the gain for the year, maybe slightly less than that just because of the end of the year uptick. But you've got this weird market and you're like, who's buying all these stocks? Well, there's only about 4 stocks out of the Magnificent Seven. They called it the Magnificent Seven because that's where it started out to be good. But, about the middle of the year, Tesla started breaking down. I mean, shoot, it's going horrible this last week. They're getting a lot of competition. They're lowering their prices and people are not buying cars. So it didn't, increase earnings or sales. You've got Apple, they decided to get out of the electric car business. That should have helped Tesla, not hurt them. You've got Google, who made this big AI blunder, and they're paying for it dearly. So you've got 3 of the Magnificent Seven that made all this money tanking right now, falling apart. You've got 4 that are kind of hanging in there, but those 4 that are hanging in there, although their earnings have increased, they haven't increased to justify opening the next day at a 40% big, huge increase of 20%, $400, $40, whatever this jump, 20% out of the gate. Before there's even any trading, the market makers decide that the price should be X. And so I know that the banks are manipulating this market as well as anybody. And even behind that is the Fed, because the Fed and the banks are kind of one and the same. They kind of work for each other. They pat each other's back. They scratch each other's back, so to speak. So, when the banks were, earlier this year failing, they continued to raise interest rates. Yet the stock market went up. Well, that's pretty counterintuitive. So they kept raising rates. Why? To try to get inflation under control. All the while they're doing a QE program to the banks. Basically, the bank bailout program is QE, quantitative easing. So there's all this extra money, but who's spending it? It's mostly the institutions. And of course, by buying the stock market up, they gave it some momentum for, a few months from was about roughly February to July-ish or August. The market went up and then just kind of ran out of gas and went down 10 or 15%. So at the end of October, they said, man, what can we do? We kind of ran out of money. We can't invest anymore, and we've got to pay this back in March. Let's just tell everybody that we're not raising rates anymore and that all is well. So the Fed comes out and says, hey, we're going to stop, put a pause on rate holds. We don't want the market to fall anymore, because we're buddies with the banks, we're buddies with the brokerage firms, and, it's kind of hurting them and hurting their business model. Besides that, come next March, we want these banks to have made enough money that they can pay back all those loans we gave them. I mean, that's what I think maybe in the back of the mind of the Fed and also the forefront of the mind of the banks. They wanted to keep making some money. And so they had this November to remember. How did that happen? Well, they essentially lied. Says, we're not going to raise interest rates anymore. We don't have to because inflation's under control. It's in check. And, we don't want to overshoot it by raising them too much, and then all of a sudden we have deflation. Heaven forbid we actually give back some of the inflation that we had and you get prices back under control and maybe even back to a more affordable rate by the time this is all over. I mean, heaven forbid they would do something like that. So let's not raise interest rates and let's just, make the market go up again. So for about 3 weeks of November, we had the November to remember, but that November to remember was not the full month. If you look at the charts, the end of November, the market started tanking again, not tanking, but it started softening and rolling over. And so what did they do the first week of December? Oh, hey, we're not just going to stop raising rates. We're going to actually start lowering rates, maybe up to 3 times next year, maybe starting in March. Well, why would they do that in March, and why would they pick March? Why would they pick a situation to lower interest rates? Well, because that's when the banks had to start paying back all their money. If they don't raise interest rates anymore and they start lowering them by March, then maybe the bank payback could be a little bit more palatable to the banks. Maybe it could be affordable. Maybe it could be a little bit more doable. Or maybe the other thought process was, man, when we call all those loans, crap's going to hit the fan and banking's going to get blown up and it's probably going to take the market down. And then we're going to have to lower interest rates up to 3 times next year, right? That's what the Fed said. But then right behind him, John Williams in New York Fed and other Fed chairs, part of the FOMC, the Federal Open Market Committee, came out and said, we've never talked about lowering rates. Shoot, we haven't even got inflation under control. I mean, it's still, well over the 2 range and still kind of pushing the 3. And it looks like it might actually be reversing trend and going upward. So we really have to kind of wait and see. But nobody talked about that. That was very, very subtly played. I mean, if there was a YouTube about it, 3 people watched it. I was one of them, by the way. But, not very many people. It didn't. That information didn't fit the narrative of what Wall Street wanted. So then you get Wall Street going up. Oh, the Fed's they said they're going to lower interest rates starting in March. And they never even said starting in March. That's what they said. And I think it was because they knew they needed lower interest rates by March to help them, pay back this, Fed term funding bank bailout program. They came up with a narrative, it's going to start happening in March, and we think there's going to be at least 4 or 5. And then other banks said, no, we think it's at least 6 or 7. So the market says, well, shoot, if they have 6 or 7 rate decreases and we get rates under 4%, maybe even down in the low 3s, shoot, that's going to make the market really go well. And if we can actually have earnings this year, the ones we thought we were going to have last year but didn't, even though the market went up 30 or 4% and probably already priced in 30% earnings growth and already priced the fact that interest rates were back down in the 3 range, all of a sudden says, we can buy stock again because, hey, by the end of next year, interest rates are going to be 3 and price earnings ratio is going to be down because companies aren't going to have to borrow money at a high rate. And with all these rate decreases, and of course, we expect earnings just to somehow magically go up 20 or 30% growth per year. And by the way, the best companies are only going up like 8 or 10 right now, unless it's NVIDIA. They're doubling their money, but they can't do that forever. But most companies that are just seeing huge stock growth and huge market participation are only growing by 10 or 12% a year, which justifies maybe a third to a half of the price they're trading at in many cases. So there's this real disconnect about what used to be reality, what used to be a market that was based at least minusculely, very partially, but at least a portion of which was based on some sort of a fundamental like growth rate, growth prospects. But now the market just says, we think earnings are going to go by 30%. And we think also, obviously, inflation is going to go down to 2 or lower and hit the benchmark, goal. Even while, the last, 3 out of 4, actually 4 out of 5 now of the last months, we've seen some upticks or we have not seen downticks in inflation. In fact, this last one was even worse because the one before that implied kind of about a 3+% rate of growth for the year as far as inflation growth. And now we're looking at possibly 5, and there's no turning it around unless the Fed actually raises interest rates. Well, what if they raise interest rates? Well, shoot, the banks and everybody else can't afford to keep borrowing at that kind of a rate. People aren't going to be buying houses. People aren't going to be, the Fed's going to have trouble paying all their debts when some of these bonds come due. All the debt that was issued when interest rate was 1% and 2% or less is now going to be refinanced as those tranches of bonds keep coming due. I mean, the Fed's in a rock and a hard place. They really have to raise interest rates to get inflation under control. And if they do that, they're going to throw us into a recession, which is kind of on the map anyway to happen. Or they can give a new QE, which will help the banks survive and continue to buy stocks and continue to drive these stocks into unprecedented levels with no fundamental reason for doing so other than the fact that they're buying them and there's a lot of suckers that are just jumping on the bus and jumping on the train and they want to go for the ride too. Now, is that necessarily wrong? Well, you might make money doing it, but you might hit the wall after the train drivers jump off the train and you don't know they did. And so, who's driving the train? It's the big banks and brokers. They're going fast. They're out of control, but they can see when the wall's going to hit. In fact, they're going to be the ones that make the wall. They're actually going to be the ones that say, we've got to take profits. And as soon as they start taking profits, they'll probably do it in unison because nobody wants to be the last bank out of the market. They want to be the first one in, and they're the big market makers. Roughly half of the entire stock market is owned by institutions, those institutions that drive the market makers, not by, households, although household ownership is higher than it used to be. And that is also another concern. When households, which are considered dumb money, own more stock because they have no reason why they're buying stock except the fact that it's going up for whatever reason, that's usually a telltale sign that there's going to be a crash or a big market correction. So as far as interest rates going down, I don't think that was ever really a possibility anyway. It was just a way to pump the market, to give the banks time to make money, to gather some funds because they're not loaning money out. That's not how they're making money anymore. If interest rates go up, typically they can make more money because they can raise credit card interest, they can raise loan interest, but they're not doing a whole lot of that. In fact, speaking of credit cards, they're having higher default rates than they've ever had before. So I don't know how the bank stocks, the big bank stocks are actually doing very well. The regional bank stocks, some of them are doing well. As a whole, they're doing okay. But I don't think the public or the investors, other than the banks themselves, really realize how thin this fence is that we're teetering on, and we could fall off either way. Yeah, I think it's probably leading to, it's going to be one of two ways. I think if they lower interest rates, inflation goes rampant, but the market looks good, and it might be, enough to help the narrative of the people in the White House to keep the White House or to think they can because, the market hasn't crashed. Look at what we did. We've saved it and all that stuff. All the while, the people that are trying to live with paychecks are paying bills. Housing's doubled in the last 10 years. Wages have only gone up about 15%. Food has gone up 30 to 40%. Gas has gone up, 30 to 40%. I don't know how people who were barely making it are making it. In fact, they're not. They're taking second jobs. They're using credit cards to buy food. That's at unprecedented highs. So if they do lower interest rates to save the banks, they're going to screw the public. if they do what they need to do, and that is just say, you know what, this market is way over, it has to have a reset, this market is way overvalued. We've really got to raise interest rates a couple more times to get inflation under control so the people in America can actually live life, with reasonable expenses so that they can pay their bills and not lose sleep overnight of how they're going to feed their families and prepare for retirement. Otherwise, it's all about the banks and Washington and Wall Street, or it's really about the American people. Unfortunately, I have a feeling the American people are going to lose. And, we'll have to see what happens in the next few weeks, starting just this coming week, as far as what the posture is on the Fed or the government saying, hey, you need to pay those loans back. I know it's going to hurt and the market might suffer a little bit. You might actually lose some money. And yeah, the public might actually lose some of their savings, but at least they'll be able to afford food and housing and stuff going forward for a little while because we can get inflation a little bit more under control. So the Fed has dug a hole so deep that they really are in a rock and a hard place. I don't know how they're going to dig out. There's no scenario that looks like a good scenario. They're all bad. It just depends on which bad scenario they want to go with.
We're talking with Jeff Olgan of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. We've been talking about current events and, in particular, whether or not the Fed is actually going to reduce interest rates this year. And the consensus is that at the beginning of the year, they said it was going to be 3 to 4 times. The first one would be in March. Now they're saying, well, maybe it might be one time. So we'll keep you updated on if and when they're going to be reducing interest rates. But right now, do not hold your breath on that. Before we get to our next segment, Jeff, I want to talk about the fact that we're offering our loyal listeners here to the radio program a Premier Retirement Roadmap at no cost and no obligation. If Jeff's views resonate with you, if you'd like to sit down with Jeff and talk to him about your individual situation, what's affecting your retirement and your financial situation, you want this Retirement Roadmap, we're offering it at no cost and no obligation whatsoever to our loyal listeners here. It's totally complimentary. If you'd like yours, call 520-780-9059. Now, we've opened the phone lines this weekend. Go ahead, give us a call right now at 520-780-9059. Leave your name, your telephone number. Shelley will give you a call back. She'll schedule an appointment for you that's convenient for you to meet with Jeff and ask your questions. Once again, that telephone number is 520-780-9059. Remember, it is totally complimentary. Jeff will not lead with the product. He doesn't know you yet. He'll have a consultation to find out what your dreams, your hopes, your goals are for retirement and to answer your questions on a one-to-one basis. Once again, 520-780-9059 for that Premier Retirement Roadmap. You can also request it online at premret.com. It's PREMRET.com. Jeff, I'm sure that a lot of people ask you about the stock market, and one of the hot stocks I've been hearing lately is NVIDIA. It's been on a tear lately, but if I remember you talking about when you were a broker, you mentioned something about selling the hype but buying something else. I mean, by the time you hear NVIDIA is tearing up the stock market, it may be too late.
Yeah, it's kind of buy the hype or buy the rumor, sell the fact. Once we find out, you typically buy before you think things are going to happen because the people in the know that are causing the rumors are sometimes bidding the stock up. And sometimes the fact isn't actually what it is. It is just all hype. I mean, there's a lot of AI hype. And we're talking about NVIDIA. That's that's really been the stock that has driven the market in the last few months, at least. The interesting thing about NVIDIA is, they've got this super cool chip. It's an AI chip. Everybody wants it. But the NVIDIA also has something that has kind of locked clients into their chip, and they've got a proprietary software that runs that chip. And, if you change chips and you don't get the software, and NVIDIA's kind of got their grip on clients to where it almost seems like, well, NVIDIA is the only player. That's the only one that can do this. But, there's other software companies out there. Amazon even has become probably a bigger software and internet company than they are a, seller of stuff they drive around your house. I mean, they've got a big footprint in the AI space and the internet space and the programming space. So does Microsoft. I mean, they're getting in the AI space big time. I mean, these companies aren't going to deal with somebody that's holding them captive or hostage. They're big enough to, market cap wise, they're not much bigger. They're kind of in the same realm as NVIDIA now. But NVIDIA just really does one thing. I mean, they've got a chip that really does a great job. You've got AMD, however, that's coming up with chips that have the same type of technology that are speedy, fast, and for companies that are getting into AI that aren't already in bed with NVIDIA, can be competitive with those companies especially, and even take some of them away. Now, Microsoft has always bought NVIDIA chips up to recently, and they probably still will for a while, but they just signed a deal a few weeks ago with Intel to have them start building their AI chips, and I guarantee you they're not going to be running running on NVIDIA software. So right now, I read a report that says, based on the market capitalization, just because NVIDIA's doubled sales on a year-to-year basis 2 quarters in a row for a year-to-year basis doubled. So a lot of companies have done that. Price earnings ratios off the charts, but in order for them to, actually expand their production facilities and be able to keep up with the demand, they've still got to spend a lot of money that they haven't actually spent yet, which is going to cut into future earnings numbers anyway. The report I saw says that NVIDIA is priced right now, their company is at a size that would indicate that every AI chip or every fast chip or every chip, but every AI chip over the next 5 years is an NVIDIA chip. And they would have to sell all those chips and still have that markup and still have that software revenue that kind of holds clients together, with their chips for the entire 5 years. I cannot imagine that the market for AI is going to double or triple in size to accommodate all the competition. And I can't imagine how the competition, that if AI is the next big thing, there's a lot of big companies that are going to be scrambling to get a piece of that. I mean, don't they think, does NVIDIA just think that they're going to be the only chip maker forever? Like Intel was for just a few years. Now they've got all kinds of chip makers. You got Micron also doing some high-speed stuff. You got AMD doing some high-speed stuff. Intel now has got some new technologies. So you've got some big chip players out there that will probably make this not a high flyer. I mean, just because it doubled, in the last 6 months doesn't mean it's going to double every 6 months. In fact, I'd be surprised if it can actually justify doubling in the next 4 or 5 years again. So there are other stocks that are much more beaten up. In fact, I mentioned Intel. I'm not making any recommendations here, but Intel's been beaten up so bad, and it's in the $40 range. I mean, I think that stock's going to double or triple long before NVIDIA has a logical reason to triple. Will it? I mean, it could. All it takes is, banks with billions of dollars to keep on driving the price up and saying, oh, we think the stock is a $2,000 stock. Then all of a sudden, all the tourist investors basically that look at the market after work and goes, oh, that one went up, I'm going to buy some. And they have no reason why they're buying or what they're buying. They just heard on the news that it was something that went up today, and they jump on the train and push it up some more. So there's a lot of hype driving the market. It's not fundamentally based. It bothers me that it's not, because I did go to college before internet, before all the communication could get out there and just hype stocks. That there wasn't really any way to hype stocks. You had to do research on every stock you bought of when to buy, when to sell, and the research was not easy. You actually worked for a living back then and managed a lot less money and had to take a commission and a ticket charge for every time you did some research and bought and sold stocks. It wasn't just, oh, let's just buy this next big thing and load up on it. Now, some mutual funds that were in the know did that, but trading was a whole different story 30 plus years ago than it is now. Now it's just whatever the whim goes. Now, is that something that we should base our future buys and investments on, or is that just speculation? Well, if you're in this for another 10 or 20 years and you're working and you want to buy some cool stocks that'll probably continue to go up over the next 10 or 20 years, that's fine, as long as you've got a paycheck. And I would still consider stocks like NVIDIA more of a speculation than an investment. Now, they were an investment when they first came out with their technology, when they were starting to be the gaming chip of the world, a few years ago. And maybe that was a time when we would call that, this is a good investment because this has got a lot of upside. Now, with the pricing as far as it is, we're basically overbuying a stock based on hype. And I'm not saying don't buy it. I'm just saying that's how I feel about a lot of these stocks that have been hyped. The thing is just the price of that stock alone, and because of the size of that stock alone, if between that one and Microsoft, which is really the only two that were really getting bought up since November by all the banks, and most of it was market makers that were buying and just shooting Microsoft and NVIDIA to the moon. And then there was a couple of earnings surprises with Amazon and Meta, which is Facebook. And those two companies laid off tens of thousands of people, which went right to the bottom line so they could show earnings growth, which was it really company growth? Was it really true earnings growth? I don't know. I think it was, in a way, it was just different bookkeeping and trying to make ends meet by cutting staff and employment that actually used to be part of their R&D and their future growth program. So if you look at what those companies did, wasn't really stellar, yet both of those stocks gapped up when they had earnings beats. They beat earnings. So the earnings is basically Wall Street saying, hey, this is what we think our earnings are going to be. So, when we buy these hyped up stocks and overpay for them, I think we're getting a little bit carried away. I think we need to bring it back down to reality. But when you look at just like one or two stocks like NVIDIA and Microsoft driving the entire market, and then you get these stocks that have a revised lower earnings estimate, and they beat that with nothing to really scream and shout about, yet the stock gaps up 20% the next day on the open and keeps going up. I don't get this market. And there's a lot of people that have done this a lot longer than I have and manage a lot more money than I do that are scratching their heads as well. And that doesn't mean Jeff doesn't know what he's doing because he doesn't know how to figure this market out. Well, maybe I don't. But, in reality, nobody really knows what this market is doing. It's really being driven by players that are at the controls, yet we don't know, what and when they're going to do. So we have to be very careful. Again, if you have plenty of years, you can speculate all you want. But if you're trying to save this money for retirement, like most of our clients are trying to do, then let's be smart about it, and let's buy stocks that still have some fundamentals, that are growing, that are priced reasonably, so that if the market ever does crash and Nvidia goes down 50%, good stocks are going to get, they're going to rotate to good stocks, and those stocks aren't going to get hit as bad. So we have to be smart about our approach. We just have to take what the Fed gives us, take what the market gives us, and do the best we can with what we got to work with. And fortunately, we can put a lot of money in safe places and still make 5 or 6% in short-term instruments that are predictable and, in many cases, guaranteed.
Jeff, hate to cut you off, but we're a little short on time. Once again, I want to point out that we're not suggesting that you buy any particular stock. We've mentioned NVIDIA and Intel, but again, we're just using those as examples. Do your due diligence and make your intelligent choices. If you'd like to sit down with Jeff, talk about anything, and maybe it is the stock market, it's your investment portfolio, what your journey towards retirement is going to look like. Again, we're offering a no-cost, no-obligation financial review with Jeff. We call it the Premier Retirement Roadmap. 520-780-9059 is the number to call to get yours. 520-780-9059. No cost and no obligation. Jeff, time for a break. When we come back, we've got listener questions and more when our show continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Vogan and Jeff Shea.
We so much appreciate you joining us here for Jeff Vogan's Premier Retirement here on 790 KNST. We're here for you every week for your fiscal fitness and your financial education. By the way, we're on the radio 4 times a week, Saturdays at 7 a.m., also Saturdays at 9 a.m. and 1 p.m., and Sundays at 11 a.m. If those times are not convenient for you, you've missed any part of the program, you want to hear it again, once again, we are a podcast. Go to wherever you get your podcast. We're on all the major platforms. Search for Premier Retirement with Jeff Vogan. You'll find this show and many of our past shows so that you can stay on top of your journey towards a confident retirement. Okay, Jeff, in this segment, we always do listener questions. We'll kick it off with Connor, who's listening to us in Sahuarita. And Connor says, I'm 73 and missed taking my RMD. What should I do next to fix the problem?
Well, that's an easy question because we're still before the tax deadline of April 15th. On the first year that you take your RMDs, and I'm assuming you're 73, you were 73 last year. So as long as you were 73 last year, you're supposed to take it sometime either before the end of the year or by April 15th, tax time of the following year. They give you a little pass on the first one anyway, because sometimes people don't know what the deal is and they wait and go to their accountant and they say, oh, you're supposed to take an RMD, and you can take that. Now, keep in mind, if you take your RMD for last year, like right now, before April 15th, then you still have to take another one for this year, which is your age 74. So no harm done, no foul. But if you don't take an RMD, and I have a client that just called in fact, recently, that it wasn't the client, it was the power of attorney. That was the son, and said, hey, mom forgot to take her RMD last year. What do I do? And the IRS is typically lenient once in a while and maybe one time. And there are forms that you can fill out to send in and say, hey, I missed it. This was the situation that happened. Normally she was, lucid enough to take those. I'm her power of attorney. I don't even know what RMDs mean. I'm only 53 years old. Can you help me out here? Can I pay it now? And, can you give me a pass? But, hopefully you don't wait 10 years to find that out. It's usually you're finding out right after the first of the year. So it's not a really big miss typically when people do that. But, I don't think you're in any trouble right now unless you're actually 74 and you missed it last year and are about to miss it again. So again, if you made a mistake and, you need to tell the IRS that you need to fix a problem, then, there's form 5329 pays the penalty if you have to, but you can also file a letter of explanation that says, hey, I'd like a waiver waiver of this penalty for not taking out my RMD, and you just send it along with it. Most CPAs can write a little form letter for you, or you can just say, hey, this is what happened. I had a lady that just wrote it handwritten herself, and it was as simple as I don't even know how they understood what she was trying to say, but they did, and they waived it. So they're not as ruthless to everybody as you might think. They really hate tax evaders, but you can make a mistake here and there, and they typically will work with you.
So if you've missed your RMD, all hope is not lost. As you said, there is a simple form you can fill out, which is Form 5329, but you can also do a handwritten note there. What is the penalty these days for missing an RMD, Jeff? It used to be like 50%. Is it still that?
I believe they lowered it to 25, but it's still high. Something in my head says they lowered. I'm not looking at the tax code. I'm just by memory. I have a lot of stuff. I have a lot of resources. I can always look that stuff up. But yeah, it was 50%. And, if you forgot to take it. So it was definitely worth, fighting to get that back. But I think they've managed to make that a little bit more palatable for those people that oops it maybe too many times or something.
Jeff, there at Premier Retirement, do you remind your clients about the RMD deadlines? Do you remind them on a regular basis so they don't miss it?
Yeah, in fact, on our managed accounts, we can actually look up and we just go through and we can see every withdrawal that they've made. So we know if they've hit their number or not, and we can, send them an email mid-December and say, hey, you need to do this by the end of the year. Or most of our clients have set up a situation where we've got their bank account and their investment account linked so that if they want to send money to invest, they can do that just by moving it back and forth. But they can also authorize us to take those RMDs out for them and put them in their account when the time is. So if they're on vacation, going on a cruise in the Mediterranean in December and forget to do that, we'll end up doing that for them by the end of the year. Now, life insurance, you don't have to do any RMDs from. That's just you take the money out when you need it in the form of a loan, and you never even have to pay it back. And so that's the easy, sneezy money. But, the IRAs that are in annuities, very often we would set that annuity up to basically pay a certain flat amount every year, which normally is more than enough to cover an RMD for several years. But we also monitor those. Every year we do annual reviews, make sure that our RMDs are caught up. We always know what the current RMD year is going to be. And so, even if we meet in June or March or whatever other month, not December, for an annual review, we have those planned out, and we can either take those RMDs early if you want to use them for summer vacation or summer to get out of here during the heat and go someplace cool, or you can wait till Christmas and use it as a Christmas bonus or whatever you want to. Again, it doesn't matter when you take those RMDs as long as you take them during the year. The transaction has to, clear your account by December 31, and it can be any time during the year. So sometimes people take the RMDs out on a monthly basis because they don't want to take just a big chunk at one time. Sometimes other people say, I like that big a chunk at one time because that's when I pay all my taxes, my bills, my Christmas, and my travel, and all the stuff gets paid, that time of year when I take my RMD. So everybody's got a different plan, but we basically, when we do an income plan, we accommodate the RMDs into that plan. And we make sure that they're linked, and we know whatever we're taking either more than exceeds the RMD amount, or that when the RMDs happen, we know that we need to go out and get those RMDs from an account that maybe we're not taking income from.
Connor, we appreciate you listening to us in Sahuarita, and of course, we'll send you out Jeff's book, Retirement: The Road Ahead. Next question, Jeff, is Linda in Savano, and Linda writes, my husband and I each plan to give our adult children $14,000 this year. My daughter may marry this year, and we would like to pay for as much of the wedding as we can. Could paying for the caterer or another wedding supplier count as a taxable gift if we pay the vendor directly?
Well, it's not even a taxable gift. You have to file a gift tax return if you're trying to make your estate smaller than, say, 10 or 20 or $30 million in order to not pay estate tax. You can gift your kids, or you can buy a wedding, you can buy cars, you can buy, if you have a kid that lives at home and you need a third car, you can buy the car and let them drive it. They're not going to tax you just because all the benefit goes to that child. You can pay for a wedding. If that wedding is for you because it's your daughter, it's
right.
Not a gift. It's your expenses. You're buying that expense for the family. It's a family. It's like a family vacation. If we had to write off, let's say we took a real expensive vacation and went on a month-long cruise, on a yacht in the Caribbean, and we're in a suite, and it costs $30,000 per person to go on this thing, and it was just a great memory builder. Do you have to write that off as a gift? No, you don't. It's just an expense. So if you're trying to just do estate freezing or estate transfers to a bunch of kids through the gifting laws in order to reduce your estate, then yeah, you have to file a gift tax return. You can give about 14. It's closer to 15,000 now, I think, but that's per child, per spouse. So each of you and your wife, you're right, can give it to each child, each grandchild. Actually, you can even give it to your neighbors. You can give it to anybody you want. It doesn't have to be a relative. But for every gift, you just have to say, hey, these are gifts, and they're within the limits that the IRS has set to not count against me in the future if I end up dying with enough money to cause me to have to pay estate taxes. Now, most of our clients, millions of dollars in net worth perhaps, but maybe not millions enough to pay estate taxes. Right now, you've got to have a $25 million estate if you're married before you're even talking about estate taxes. However, if you got some real estate portfolios and you think they could double or triple in size and, you're going to keep putting away the rent money and invest. I mean, maybe you've got $5 or $10 million in asset value and it's going to be over that number in the future. Maybe you want to start gifting money away so your own estate doesn't grow into those levels. We also have some tax laws that are sunsetting and some speculation that the estate tax limit is either going to go down to $7,000 or $8,000 per couple or possibly $4,000 per individual on the estate taxable basis. Well, you might say, oh, well, I'm still far away from that. I've only got a couple $1 million in retirement funds. Well, depending on how fast you spend them or depending on how well you do on your investments, it could be worth more. And, maybe you want to do some gifting. But I don't think until, the laws change to a point where you feel like you're in trouble. And if you look at a 20 or 30 year or a several decades long estate and financial and income plan during retirement, we can kind of guess about where you're going to be in the taxable estate when you pass away, by just putting in some reasonable assumptions as far as, asset growth, expenditures, income plans, what's left in the estate when you pass. And it might indicate to us, you're going to get into a problem here. So we think gifting is probably a smart thing to do. And what you can do with that gifting money, you can actually gift it to your kids. By the way, you don't have to just give it to them to spend. If you like that, that's great. But let's say you have grandkids that you don't want to give them to us to spend. You can actually gift it to them, have the parents sign a letter that says, hey, my son disclaims or my daughter disclaims this gift. And then you can set up a trust outside of your estate that you can actually invest that money in or grow it, for them in the future. You can also use life insurance so that when the second of you dies, they get a tax-free death benefit when maybe they're in their 20s or 30s and are old enough to pay off student loans and buy a house. And so there are really creative ways to use that gifting, even if you're not trying to just give it away so they can spend it now and, have a better life and you don't have as big of an estate tax. But it's also, you could actually build a bigger estate that's not taxable at 40% or whatever the tax rate's going to be on the amount over and above whatever the unified credit or in other words, the exempted amount is in the future. So you can do some creative estate planning, even if you're not super rich, just by setting up trusts for generations beyond you. So keep that in mind. We do estate planning here and I understand how it works. I'm not a lawyer. I don't do the documents, but we know how to maneuver around those future tax problems that you might encounter, get you out of probate, make sure that your kids' heirs get the money left to them how you want, when you want, with the least amount of taxes and trouble.
Jeff, let's say that Linda and her husband want to gift their daughter and new son-in-law maybe $50,000, $60,000 to buy a house. If they gift that sort of money, there is going to be a taxable event involved in that, I would assume. But let's say that they say that it is a loan. I mean, how can they get around the taxation if they do that?
Well, you could do a loan and they just pay it off later, when they sell the house or whatever. You could even do that. And if the loan's never paid back, oh, well, it's forgiven. By the way, a gift is not taxable. What a gift is if you exceed that, all you do is you have to file that you've used up some of your unified credit. In other words, you've used up some of your exemption on your exempted portion of your estate. So if the estate taxes end up being $8 million when you die, but you've only got a $6 million estate and you gave your kids $3 million, it's inconsequential. It doesn't even matter. If, however, you gave your kids $3 million and your estate's $8 million right on the button, then good for you. You gave them $3 million over the last 30 years because you gave, $100,000 a year for the last 30 years. And that's assets that you don't have to pay tax on in your estate because you filed the gift tax return. So it's never actually has to be taxable. Now, here's when it would be taxable. And that is if you gifted it away all at one time, and you gave the $3 million right now because you sold a big apartment building and you said, oh, well, here's $3 million, we'll give $1 million to each of my kids. And you file a gift tax return that says, hey, this is over the exemption amount. So I realize that, I might have to pay estate taxes on this if I exceed the level. And so then now if at that particular time you have $5 million and the exemption is 8, you're still underneath the exemption. However, if you have $8 million, that gift tax return is going to tell the IRS, hey, you gave away a bunch of money a long time ago. You used up your unified credit, $3 million of it. So instead of having $8 million, which is what everybody else gets, you only have $5 million because you gave $3 million of it away 20 years ago. Well, here's what you could think, well, that kind of sucks. Well, no, it doesn't, because if that $3 million was still in your estate and you would have tripled it, then they've got another $10 million that would have to be paid estate tax on at 40%. There's another $4 million in taxes. The way it sits now, maybe you pay $700,000 or $800,000 in taxes on the $3 million that you end up getting hit by. So it's still probably a smart thing to move assets out of your estate if you think you're going to be in an estate tax problem situation because you've saved a lot, you've invested well, or inherited money, whatever it is. If you have an estate tax problem or in the foreseeable future could have an estate tax problem, it doesn't hurt you to gift money, but just file that estate tax form. It's basically the gift tax form. It's not a gift tax. It's basically a gift exemption that you're using up that may be taxed in the future, but it may not. So it may all wash out in the end.
We're talking with Jeff Logan of Premier Retirement Planning and Wealth Management, and we're answering listener questions. Linda had a question about gifting her daughter as far as a wedding goes and the son-in-law, and we've explained that. So, Linda, thank you so much for that question. We will send you out Jeff's book, Retirement, The Road Ahead. Jeff, before we get to our third question, I want to remind our listeners that if they want to talk to you, 520-780-9059 is our telephone number. Give that number a call this weekend and request your Premier Retirement Roadmap. No cost, no obligation whatsoever. Not going to cost you a dime. 520-780-9059. As I said, you can call it right now if you want. Leave your name, your telephone number, and Shelley will give you a call back during the week to set you up with an appointment with Jeff so you can ask your questions and get yourself on the path to a prosperous retirement. Okay, final question here, Jeff. Clayton listening to us in Green Valley, and Clayton says, my sister is 72 and is worried about lifetime income. She met with an insurance broker who wants to sell her an annuity. I told her that I think she might be too old for that to make sense. What do you think an annuity at age 72 would be like?
Well, as usual, my answer is going to be it depends. It depends on the annuity. It depends on what the goals of the person are. I've got some clients that, hate the word annuity just because it was ingrained into their system to hate annuities because, grandma had an annuity. She put $100,000 of her savings into it and then died a week later. And the $100,000 was gone and she only got one payment. That would make you hate annuities. I would hate that annuity too. Or, somebody got an annuity, it was a variable annuity when the market was high and it was all variable, meaning it was invested in stock market assets, but, might have guaranteed some sort of an income or maybe even guaranteed some sort of a death benefit. But, the market went down. The annuity went from $500,000 down to $300,000. And, mom needed her money because she needed to move into a better place that was more conducive as she was getting older, needed to, have wheelchair ramps and different things. And her house, their 2-story house wasn't doing it for her. So all of a sudden she needed the money and, had to take it out at a big loss. So, there are annuities that you should hate. And by the way, variable annuities, are market correlated, plus their fees are exorbitant. 4 or 5% is not uncommon to see layered fees in a variable annuity, which very often is the broker dealers that tell you to hate annuities are the ones that sell them because, commissions and fees, you get commissions up front and you get fees ongoing, generally speaking, on a variable. And it's very, in my opinion, very inefficient. I can't find a justifiable reason since about 2003 or 4 to actually use variable annuities. Honestly, there's so many other ways to do it. You can buy mutual funds if you want the risk at much lower cost, and you can buy a fixed guaranteed annuity that pays more income if that's really what you want. And if you want a death benefit, then buy life insurance. So you don't have to try to combine everything into one policy that tries to do everything at huge expense to you. So stay away from variables. Stay away from the ones that if you die too early, you don't get all your money back. But honestly, annuities were really built for retirees. Social Security, do you know that's an annuity? Social Security is an annuity. It wasn't built for people in their 30s or 40s or 50s. It was built for people in their 60s and 70s and 80s. It's an annuity. Why is an annuity important? Because it creates income that you used to get from a paycheck, and it creates an income that you can, go to your mailbox and find a check in there every month. Or in reality, you look at your bank statement and it's dropped in there every month. So you've got that money that comes to you every month to pay all your bills. And let's say Social Security, obviously we know Social Security isn't going to be enough to pay for most people's retirement. Very few people can live on just a Social Security paycheck. And if they are living on just a Social Security paycheck, it means they probably didn't make a ton of money in order to have a 401k. So they're, it might be used to living on less, but their Social Security paycheck's probably even smaller than it is for most people. So I don't expect anybody to be happy living on a Social Security paycheck, but I also don't think people ought to be living on money they invest in stocks, even if they are the Magnificent Seven, and even if they do double or triple in a year or two, because they could also go down 50%. And, when you spend money out of a volatile account, it will run out faster in spite of what it might average over a period of time. So annuities are a more secure way to either guarantee or at least get predictable monthly income that replaces a paycheck that maybe you used to get. Maybe she lost a husband recently and is single now, and it makes more sense to have an annuity because, husband's Social Security is now her Social Security because hers were lower, but, she's at a deficit of $2,000 a month because there's only one Social Security paycheck coming into the house and lost part of the pension. She's not really good at investing in a stock market and making stock picks or knowing when to sell, and doesn't want to get out of bed and have to turn on the TV to see what the stock market's doing every day because she doesn't want the gut ache. In that case, an annuity is absolutely the best, smart smartest thing, in my opinion, that you should do for somebody that wants those things. So we like annuities. I mean, rich people, poor people, and in between people like annuities because it replaces some of the income that they used to get in the form of a paycheck. With that predictable income, or if let's say you like to live on $150,000 a year, but you have to have 100, well, Social Security's, no matter how high you're at, you're probably not hitting, even if you had really high incomes, you and a spouse, it's probably not going to get to 100. So maybe you take half of the $1 million that you have in your 401k and you put it into an annuity that'll generate another $35,000 or $40,000 a year guaranteed to get you to that 100 guaranteed. And then you've got another $500,000 that you can buy stuff like NVIDIA or Microsoft or Apple or Amazon or all those big tech companies or some of these new up-and-comers like Supermicro Computer and some of these things that you might have heard about. This is not a recommendation of buy, sell. I'm just saying there's some stocks out there that just high flyer crazy. If you want to try some because it gives you the adrenaline rush, do it with money that doesn't pay your everyday bills. If you need an extra $20,000 or $30,000 or $50,000 a year to live on, then let's invest the rest of that money to generate the potential income that you can use for those extra expenditures. But know that it's okay to take risk on that money because all your bills on the $100,000 that's guaranteed for the rest of your and your spouse's life is guaranteed forever, and you don't have to worry about the bills being paid. You don't have to worry about if a stock gaps down 20 or 30%, or if we wake up Monday morning and find out the Fed's going to, repo all the bank assets in order to pay off those loans that they, gave them a year ago, and they're going to, force them into, next to a bankruptcy situation, and all of a sudden the market just, crashes and closes down for. I don't think that's going to happen, but why would you put your entire nest egg in the market when stuff like that could happen? Do you remember 9/11? That happened, shut the markets down, didn't even open for a few weeks, and then they did it, and they kept closing down because there was people freaking out and running for the sidelines, and they couldn't accommodate enough buys for the sells that people wanted to get out of the market. And so if we hit rough times, you don't want the money that you need for income every month to be stuck in that kind of an investment. So again, I like the steadiness and the fact that insurance companies that guarantee you income, the ones that we like to use anyway, are not going to risk your principal or your money or that monthly paycheck, regardless of what the market's doing. So keep your income non-market correlated, but make it enough so where you don't have to worry about the money that is in the market. When things go bad, you don't have to freak out because it's going to change your lifestyle or change your monthly paycheck.
Clayton, thanks for listening to us. Good luck to you and your sister. We, of course, will send you out Jeff's book, Retirement: The Road Ahead. If you've got a question you'd like us to answer on the air, very simple to get it to us. You can send it to us by going to our website, which is premret.com, premret.com. Put your question there. If we do use it on the air, of course, we will send you out Jeff's book, Retirement: The Road Ahead. Once again, if you've got questions or comments about the radio program, maybe something you want us to talk about, you'd like to get in and sit down with Jeff and talk to him about your individual situation, we're offering a no-cost, no-obligation retirement review. We call it the Premier Retirement Roadmap. No cost, no obligation for that whatsoever. Our telephone number, 520-780-9059. Go ahead, give it a call right now if you would. Leave your name, your telephone number. Shelley will give you a call back and set you up with an appointment with Jeff. Again, that number, 520-780-9059. You can also request your plan online at premret.com. That is premret.com. Jeff, in the first part of the program, we were talking about NVIDIA, some of the chip stocks, and it got me to thinking, if someone is looking at stocks, and you talked about fundamentals, looking at the fundamentals, what does that mean? What are we really looking for when we're looking for the fundamentals?
I don't know if I should even go down this road because, who even looks at them anymore? There's a few things that I like to look at. One is just pure momentum and the consolidation of what a chart looks like. I can look at stock charts and see what the momentum, the trend. The trend is your friend. The trend is one of the things. NVIDIA's got a trend and it's a serious uptrend, but it's really kind of sporadic. There's some sell-offs and there's some rebuys, there's some gaps. That's kind of a scary thing. That gives, to my mind, kind of a look of uncertainty or manipulation, which it is. It's one of those that is being manipulated. It's not just an orderly buying where every day it goes up a little bit. If you look at a stock, and I'll throw some out there that you can look at charts on, but I've been watching one, General Electric. They don't just sell toasters and radios anymore. But if you look at the trend, as they're getting into jet engines, they're getting into nuclear power. They've got a lot of things that don't have anything to do with the old GE, General Electric, light company that made light bulbs and radios. So we've got a different kind of a flavor of a very solid industrial stock everybody knows. Well, if you look at that, you look at, the growth trend is, reasonable. The earnings and the sales are growing on a pretty steady basis. You've also got a price earnings ratio of, I think it's under 20, if I'm not mistaken. I can look it up really quick here. But GE's got a price earnings ratio of about 20. It's 19 or 20 right now. That means you're going to pay $19 for $1 worth of earnings. And that's based on earnings that continually to grow at a pretty good clip. Now, if earnings growth is between 10 and 20% per year, I think that we can look at that as being a good, fundamentally sound stock, especially when you go back and look at the last 6-month trend, which since November, down around $100 is now 162. It's had a tremendous ride. Now, does that mean it's time to sell? Maybe, but it's on a very tight trading. It doesn't go up or down $20 in a day. It doesn't go up or down 1 or 2, maybe. It keeps within a nice range. So that's the kind of, way I would look at a stock and say, okay, the fundamentals make a little bit more sense. The trend is they're growing, their earnings are getting better. They're not taking really massive action to drop different, research and development phases of their business. They're not laying off tens and 20s of thousands of people at a time. That kind of make you wonder, okay, if they're not able to sustain their current level of growth, if they're doing that kind of a thing, even though it might fix their books and, make it look maybe a little bit better. And then you've got companies, I think are pretty high priced. Now, Tesla's, been going down. I mean, they've actually got a price earnings ratio of about 45, but they're losing money. So is that a good fundamental? No, I think that's pretty high. The average or the normal price earnings ratio of the market in general, when it's considered fair values, is somewhere in the neighborhood of 15 to 17 on a price earnings valuation. Now, people for some time have been willing to, pay for stocks that have price earnings of 100 or more just because people are willing to pay that price for stock. But if you look at history, the price earnings ratios, which is, one that I just can't really leave alone. I mean, it's not the only thing, but it's one of those screening tools that I use is like, okay, are we overpaying for this stock? Is it more or less in a reasonable area? Now, if you pay, let's say NVIDIA, for example, now it's had, 2 or 3 quarters of just crazy high earnings. Now, price earnings is 70. That might not look bad, except the fact that because earnings have jumped and gapped so high, the sustainability of that kind of a growth rate is beyond reality, in my opinion. It doesn't make a lot of sense that they can continue to double their revenue growth on an annualized basis, quarter to quarter, for very much longer. You can't do that. You just can't.
Jeff, I hate to cut you off, but we are short of time. Once again, our telephone number, if you'd like your complimentary retirement review, 520-780-9059. Jeff, out of time for this week. Thank you for your time, but also I want to thank the fine people here in the greater Tucson area for joining us. For Jeff Hogan, I'm Jeff Shade. Have a great weekend. We'll talk to you again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. This show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.